Western jobs report this morning. Look, you've been optimistic about the economy. Is that changing? What is your outlook for 2019 and beyond?
Well, thanks very much, Neil. It's great to be here. Also great to be with Janet and Ben, as always. I'll talk a little bit about 2018 and then turn to the outlook, if I may. So 2018, by so many measures, was a good year for the United States economy. And most of the hard data that we see coming in remain quite solid and suggest ongoing momentum heading into 2019. You mentioned this morning's jobs report. For those of you who haven't seen it, we had 312,000 payroll jobs added, a very strong number. We have unemployment remaining below 4% for 9 months now, the longest period since the mid-1960s. We have labor force participation picking up again and surprising to the upside, which is very, very welcome. And finally, we have wages, which are continuing to gradually move up. Average hourly earnings moved up, and that's quite welcome. And also, for me, at this time, does not raise concerns about too high inflation. So, very strong report today. We've also seen, on a more forward-looking basis, we've seen initial claims for unemployment insurance near their historic lows, and so that's more of a leading indicator, and we still see real strength there. Consumer spending has been strong right through December. The reports we're getting from the retail industry suggest continuing spending right through the holiday season. I would say those are all good data points. There is yesterday's Institute for Supply Management report, which came in well below expectations. And I would just provide a little bit of context there. The ISM report is a survey of manufacturing conditions, and it had been at historically high levels, in fact, higher than it had been even in the strong expansion of the late 1990s, and much higher than it had been during much of this expansion. So it's now at a level which is considered consistent with ongoing moderate growth, and is about at the level or even higher than it's been in the earlier years of this recovery. So that's a little bit of context. I would say the fact that it moved down so much in 1 month is something worth keeping an eye on. So notwithstanding that report, though, I would say U.S. data seem to be on track to sustain good momentum into the new year. I'll talk about China for a second. China's been a big part of this story, and the most recent data from China have been more mixed. China's consumers appear to be pulling back, as seen in the Apple news and in the weak retail sales data. The 2 PMI reports we got earlier this week show softening in domestic and external demand, and this weakness seems to be spilling over to other emerging Asian economies and to global commodity prices such as copper, for which China is such a big buyer. That said, Chinese authorities are responding with additional stimulus, and China and the rest of emerging Asia should continue to expand at a still solid pace this year. So overall, I would say the picture for the rest of the world remains consistent with continued growth here in the United States. So good data still, I think, is the story looking in the rearview mirror. But financial markets have been sending different signals of concern about downside risks, about slowing global growth, particularly related to China, about ongoing trade negotiations, about what maybe let's call general policy uncertainty coming out of Washington, and among other factors. So, you do have this difference between, on the one hand, strong data and some tension between financial markets that are signaling concern and downside risks. And the question is, with those contrasting sets of factors, how should we think about the outlook, and how should we think about monetary policy going forward? Now, when we get conflicting signals, as is not infrequently the case, policy is very much about risk management. And I'll offer a couple of thoughts on that to wrap up. First, as always, there is no preset path for policy. And particularly with the muted inflation readings that we've seen coming in, we will be patient as we watch to see how the economy evolves. But we're always prepared to shift the stance of policy and to shift it significantly if necessary in order to promote our statutory goals of maximum employment and stable prices. And I'd actually like to point to a recent example when the committee did just that in early 2016. And I mentioned this in this December press conference in passing. As many of you will recall, in December 2015, when we lifted off from the zero lower bound, the median FOMC participant expected 4 rate increases for 2016. But very early in the year, in 2016, financial conditions tightened quite sharply, and under Janet's leadership, the committee nimbly, and I would say flexibly, adjusted our expected rate path. We did eventually raise rates a full year later in December 2016. Meanwhile, the economy weathered a soft patch in the first half of 2016 and then got back on track. And gradual policy normalization resumed. Now, no one knows whether this year will be like 2016, but what I do know is that we will be prepared to adjust policy quickly and flexibly, and to use all of our tools to support the economy, should that be appropriate, to keep the expansion on track, to keep the labor market strong, and to keep inflation near 2%. And I will stop there. Thanks.
So Chair Powell, as you note, since the last FOMC meeting, markets have moved in big ways. 10-year Treasury yield is down 0.25 percentage point. The Fed funds futures path is suggesting no rate increases, maybe even rate cuts in 2019. Are the markets telling you that you made a mistake?
I think the markets are pricing in downside risks, is what I think they're doing. And I think they're obviously well ahead of the data, particularly if you look at this morning's labor market data and the other data that I cited. So markets are expressing concerns, again, about global growth in particular. I think that's becoming the main focus, and trade negotiations, which are related to that. And I'll just say that we're listening carefully to that. We're listening with, sensitively to the message that markets are sending. And we're going to be taking those downside risks into account as we make policy going forward.
Now, at your press conference, you affirmed that you intend to allow the balance sheet to continue shrinking at a steady rate. Would you reconsider those plans in light of this flexibility you spoke about a moment ago?
Yeah, so let me talk about the balance sheet. Some years ago, we decided that rate policy was going to be the active policy tool, and that the balance sheet would be allowed to shrink gradually and predictably in the background. And it was supposed to be about as interesting as watching paint dry in Janet's famous locution. So, and that division of labor has served us well, and we think has served the economy well. And so we also said at the very beginning, I think in our original, certainly the first policy normalization plans that I was involved in 2014, we said that we would be prepared to adjust our normalization plans as appropriate to achieve our goals. So if we ever came to the conclusion that any aspect of our normalization plans was somehow interfering with our achievement of our statutory goals, we wouldn't hesitate to change it. And that would include the balance sheet, certainly. So I would say today, of course, we're hearing a lot from different groups of people about the role that the balance sheet normalization may be playing in the markets. I think we are of the view that what really happens mechanically when our securities mature is Treasury issues a comparable amount of securities, but they do so across the yield curve. The amounts are not that big. They haven't been that big compared to the issuance Treasury is already undertaking. So we don't believe that our issuance is an important part of the story of the market turbulence that began in the fourth quarter last year. But I'll say again, if we reached a different conclusion, we wouldn't hesitate to make a change. If we came to the view that the balance sheet normalization plan or any other aspect of normalization was part of the problem, we wouldn't hesitate to make a change.
So let's broaden our conversation now. Dr. Yellen, if this expansion lasts into next summer, it'll be the longest on record. You played a significant role in making that the case. How confident are you that this economy is on track to keep growing through 2019? How worrying do you find these latest moves in markets and some of the survey data?
Well, I agree with Chair Powell's assessment that he just offered up. The data suggest we have a pretty strong economy. Consumers, consumer spending is 2/3 of all the spending in the economy, with strong job growth and income growth, debt burdens having been reduced substantially, housing prices having risen, oil prices down, putting some money in consumers' pockets. I think consumer spending, and it looks, as Jay said, as though spending over Christmas was strong. That's a strong base for the economy next year. I don't think that expansions just die of old age. Two things usually end them. One is financial imbalances, and the other is the Fed. And Usually when the Fed ends a recession, it ends an expansion, it's because inflation has gotten out of control and the Fed needs to tighten to bring it down. And I think the Fed is now very well positioned with inflation being low and inflation dynamics being favorable in the sense that the linkage, so I believe that there is a linkage between slack in the labor market and product markets and inflation, but the strength of that linkage is not very great. So we have a relatively flat Phillips curve is another way of putting that. And in addition, inflation expectations seem well anchored, and so inflationary dynamics are very favorable. It gives my former colleagues the opportunity to be careful, to move gradually, to be data dependent, to manage the risks, and I have confidence that they'll be able to do that. And I don't really see financial imbalances in the economy at this point that look to be threatening. So, of course, we have had a tightening of financial conditions. Markets are obviously worried about downside risk. There are we are seeing some slowing in the global economy. I believe growth is likely to slow quite a bit next year, but still likely end up being above the growth rate of potential, which is consistent with a strong labor market and maybe even some further tightening.
Dr. Bernanke, you spoke once of a Wile E. Coyote effect as this fiscal stimulus impact of the tax cuts fades, that we might find ourselves in a bad spot over a cliff looking down. Are we looking at that now? Is that part of what's being priced in, and how much is that fear something imminent?
Well, I think we have an excellent chance of breaking the all-time record for an expansion, a 10-year expansion in the middle of next year. It's likely that the economy will grow more slowly in 2019 than in 2018, and maybe even more slowly in 2020. This is not something that is news. I mean, we've anticipated this for a long time because the fiscal policy in particular that was enacted close to a full employment starting point, we knew that barring changes in the law that stimulus was going to be dying down over time, and that's certainly going to be slowing growth, all else equal. Financial conditions were, if anything, a little bit ebullient, in 2017, early 2018. To some extent, what we've seen, this tightening we've seen, is a take back of some of that, particularly with concerns about geopolitical considerations, trade wars, and the like. And then, of course, the sort of perfect confluence of synchronized growth we saw in 2017 is also globally has also been a little bit less strong. So all these things do suggest some moderation. But as Janet says, expansions don't die of old age. I like to say they get murdered instead. And right now,
murderers not here.
Right now I don't see anyone's hiding behind the curtains. But some slowing does seem likely. Let me just say, that it is a good thing that the Fed has the flexibility to respond in a way that will be responsive to the data, responsive to the markets, and that manages the risks that are obviously on both sides of this.